All right, so let's jump right into things. Once again, thank you so much for joining us today. Just to introduce myself, my name is Jonathan Brandeo. I am the Director of Learning and Development here at MLB Wholesale. And today, what we're going to be talking about is temporary buy downs. They are one of the most effective tools available right now to help borrowers afford today's housing market without permanently changing the actual mortgage product itself. So, of course, we are all right now having conversations with buyers who are concerned about where the interest rates are at. Many of these qualified borrowers are just simply waiting because they're wondering, when are these rates going to go down? Are they ever going to go down? And really focused on what their monthly payment is going to be, other than the long-term opportunity that home ownership really comes with. A temporary buy down gives us another solution. And that's exactly what we're trying to look for here at MLB every single day is solutions in order for us to reach towards our specific mission, which is making lives better. So instead of telling a borrower what today's rates are, we can start having that conversation with them on how we can make today's payment much more affordable for them. Now, going back to our mission of making lives better, one way that we can accomplish that is by providing these type of creative financial opportunities for them that help them achieve home ownership while at the same time allowing you to grow your pipeline and differentiate yourself from others. So today what we're going to talk about is what is a temporary buy down, which loan programs allow for them, how do they work, how are they funded, and the important underwriting requirements, along with the best practices for discussing them with your borrowers and your partners. So let's get started, jump into the world of temporary buy downs. If you have any questions, feel free to throw those into the chat box here in Zoom. We'll circle back around to them, and we'll have a little bit of some time at the end as well to go over any questions you may have based on what was presented. Of course, everybody who attends our webinars will receive a follow-up with a link to the presentation slides that I'm using today. But you can also go to mlbwholesale.com to download the slides and find direct links to our YouTube channel where we post the recorded versions of these webinars. So you can always reference back to these training materials at any time you need a little bit of a refresher. So let's jump into things and talk about temporary buy downs. So starting off with kind of the bare basics here. A temporary buy down is not a loan program. What it is a financing strategy that temporarily lowers the borrower's interest rate for the first 1 or 2 years of the actual mortgage. Eventually, the loan itself will return to the original note rate that was established at the closing. But kind of the question you're asking is, why is this so valuable? It's because those first few years are often when the borrower experience the biggest financial adjustments. They're furnishing the home, they have their moving expenses, building up their emergency savings, maybe possibly planning to start a family, or simply just adjusting to being a homeowner. That temporary buy down eases the transition by lowering the monthly payment during those first years. Some kind of key benefits here that go directly to our families are lower monthly payments immediately after closing, the increased purchasing power to go out and buy that home that they want to buy, an easier transition into the world of being a homeowner, relief during those high rate environments, so especially in today's world. Often, these are funded entirely through seller concessions. And overall, it creates a tremendous opportunity for you as a loan officer to solve affordability challenges without waiting around for the rates to decline. So instead of waiting to say, oh, maybe one day the rates will go down, actually, we can help out these borrowers right now. One of the biggest advantages of using a temporary buy down is the flexibility of how they can be used. Here at MLB Wholesale, we can actually use it across multiple different types of loan products. This includes specifically FHA, VA, conventional, but only on Fannie Mae. So keep that in mind. For conventional, it is Fannie Mae only. It can be also done on USDA And it is also available for some of our non-QM programs as well. The two different types of buy downs that we offer here at MLB is a 2-1 buy down and a 1-0 buy down. It's also important to understand the eligibility requirements that go along with this. Now, when it comes to agency has a 580 minimum FICO. So 580 for your FHA, VA, Fannie Mae, USDA. For your non-QM does go up to a 680 minimum FICO on any of those types of programs. Non-QM is also maxed out at an 80% LTV with a 50% max DTI. It is only available for 30-year fixed, and the 2-1 buy down is the only option available on the non-QM products. So it is available on non-QM, but just keep in mind that non-QM has a much more restrictive basis when it comes to the world of temporary buy downs, whereas with your agency programs, you have the lower FICO requirement and a much more flexibility when it comes to those options, both the 2-1 and the 1-0. So knowing what these guidelines are allows you to identify these opportunities as early into the process as possible as you're having those conversations. That way you're able to structure those loans properly when they're ready to go ahead and move forward to the next step. So like I mentioned, we have those two different options available. The first one we're going to talk about here is the 2-1 buy down. This is probably the most popular option that people go towards, and here's exactly how it's going to work. So what happens is we're going to look at the different years. Looking at year one, the borrower's payment is calculated using an interest rate that is 2% below what the actual note rate is. When the time goes there is that when we get to year number two, the payment increases slightly and it's based around a 1% below the note rate. By the time to get to year number three, that is when the note rate that we closed on is going to go into full effect. So the borrower is now, by year three, simply paying the original fixed note rate for the remainder life of that loan. So year one, 2% lower, year two, 1% lower, and then year three, they're paying the note rate that we closed on. So that's the biggest thing here. The interest rate itself isn't changing permanently. The mortgage remains at a traditional fixed rate loan. The difference is that the borrower receives temporary payment assistance funded through this buy down account. So when you discuss it with a borrower, you're focusing more on payment rather than what the rate actually is. So instead of saying to them your rate is reduced, what you actually say is that for the first year, your monthly payment is based on the lower effective interest rate, making homeownership much more affordable. It's a much easier way to explain that to those borrowers and help them understand. You can see there's an example on the slide here is that let's say the purchase price is 450,000 and then the down payment is 90,000, loan amount 360. Interest rate, your full 30-year fix is at 6.5, for example, and then annual percentage rate of 6.619. When you put those numbers in, you'll see that for that first year, the rate is 4.5, then it goes to 5.5, and then years 3 through 30 are going to be the full 6.5% fixed rate that we closed on and what was locked when you locked the loan with MLB. Making that kind of buy down, the buy down goes down to zero by the last year. Borrower's payment increases each year, but it allows for that first year especially, and even of course in a little way for the second year to cover and have a lower monthly payment for them, helping them financially in the long run. Now, other than the 2-1, you also have the 1-0 buy down. The 1-0 buy down works similar to exactly what I just showed you, but it's much more simple because instead of it being 2 years, it's only covering for 1 year. So the borrower's payment is reduced for the equivalent about 1% less during the first year only. After that first year, the payments return directly to the full note rate. So what happens here is that you would go with a 1-0 buy down because this option often requires a smaller seller contribution while still providing meaningful monthly savings. It's a great option for when seller concessions are limited, um, builders that offer smaller incentives. The borrower still only needs kind of a short-term payment relief, because sometimes even a small reduction in payment is enough to help a borrower qualify and feel much more comfortable with moving forward to the next steps. The biggest piece here is kind of determining as a loan officer which of these two options I just went over is the best value for the borrower in the long run. Do they need that assistance for 2 years, or can they go ahead and just get that 1 year of assistance, and that will allow them to kind of move smoothly more down the process and create better financial position for them in the long term? Now, how are buy downs funded? Who is actually paying for all this to allow them to have those lower payments over the first 2 or 1 years? That's, of course, the most common question that you're going to get. The answer is pretty straightforward. Temporary buy downs are funded through seller concessions. They should only be funded through seller. That's the biggest piece here, is that it can come from seller concessions, builder incentives, or interested party contributions, or IPCs. The borrower is not paying any additional money each month. Instead, what's going to happen here is those funds are deposited into a separate buy down account at the closing table. Each month during the buy down period, money from that account supplements that portion of the borrower's payment. This means that the lender actually receives the full scheduled payment while the borrower still enjoys the reduced monthly obligation. This is also a fantastic conversation starter when you're working with realtor partners as well, because seller concessions can become a powerful negotiating tool. Rather than reducing the home's price itself, a seller can actually just provide contribution towards that temporary buy down, because it can make the home much more affordable to a larger pool of borrowers. That way, we're actually helping out our referral partners as well. You're gaining more trust with them, and you're becoming that person that they want to go to and send more business to in the long run. Biggest thing here, once again, is that the borrower cannot use any of their own money towards this. Buy downs can only be sourced from a seller or a builder acting as a seller. Now, there can be situations where things happen post-closing and the actual funds that were put into that buy down account have not been fully used. What would happen in those types of situations? Now, the common situations would be as if, unfortunately, a foreclosure happens. If a foreclosure happens, any remaining funds in that buy down account will go towards reducing the outstanding mortgage balance. If the borrower decides to pay off the loan early, the unused funds will reduce the actual payoff amount. If the borrower sells the home completely outright, same thing. The remaining funds in that account will be credited towards the actual payoff. The important thing to remember is that those funds never simply disappear. They're continuously benefiting the borrower and or reducing the actual remaining debt in those different types of situations. Understanding that these types of scenarios are possible and how that money is used towards these scenarios helps makes everybody that's part of the transaction more comfortable moving forward and understanding how a temporary buy down really works. Now, the last slide I have here in our presentation, I just want to go over some important underwriting guidelines. First things first, every temporary buy down requires a written agreement between the funding party and the borrower. This is something that will be actually signed at closing. Like I mentioned earlier, borrower-funded temporary buydowns are not eligible. They are seller-funded only. So it has to come from a seller or an interested party contribution. The borrower cannot use their own money towards buydowns. The funds must come from an acceptable interested party, like I mentioned. Finally, and probably most importantly, the underwriter is going to qualify the borrower off of the full note rate. So the borrower still needs to qualify. Like the example we showed earlier, the note rate in that example was 6.5. So even if the first year it's 2% lower, that 6.5 is what that borrower has to qualify off of to get a clear to close. That way, by the time we get to year three and they're paying the full note rate, we know that they're still qualified by the time they get there. Even after that temporary payment reduction ends, the borrower has already demonstrated their ability to pay that payment. We also here at MLB offer a temporary buy down calculator. That is something that's available on our website. I strongly encourage everyone, if you're looking into temporary buy downs, use this tool that we have on MLBwholesale.com. There's a link within the presentation here as well. When you're having discussions with your partners about payment scenarios, whether you're talking to a borrower or you're talking to a realtor, you can use that temporary buy down calculator to more confidently and clearly explain how you would structure that specific scenario if you're using a buy down. Showing those partners what those actual payment savings are going to be creates a stronger conversation instead of just discussing what the interest rates are in the pricing engine. Now, before I wrap things up here, I want to say that learning does not stop with our presentation today. We all know that guidelines and systems and portals and technology is continuously evolving, and each new item there that I kind of went over creates additional opportunities to help more families and our partners. And that's why we offer live training sessions every single day. And one of the big things I want to focus on here and just shout out, if you haven't heard already, is our MLB Certainty. MLB Certainty is an AI pre-underwriting tool that we have developed internally here at MLB Wholesale that is available to all of MLB Wholesale's partners. In order to get access to this incredible new AI tool, you are required to complete one of our live training sessions that we host daily, whether that be Monday, Wednesday, Friday at 11 a.m. Eastern, or Tuesdays and Thursdays at 4 p.m. Eastern. Join us for one of these trainings to learn more about how this incredible tool can change the dynamic of your day and using technology to make you more human, allow you to give you more time to create new relationships, build your pipeline, instead of just doing the menial, repetitive work that we're doing day to day, reviewing documents, doing income calculation, all of that. Let this technology do that for you and learn more exactly how it can do that. And like I said, it's completely free to all of our partners. We just ask you to join one of our live trainings to learn more, get a demo of the system, and we'll go over more details about it. So you can use the QR codes here on the screen to sign up for a call if you haven't joined us already. But you can also go to MLBwholesale.com to learn more and sign up for one of our upcoming trainings. Now, other than MLB Certainty, we do have live trainings every week about different topics, just like today. So you can learn new products, ask live questions, review borrower scenarios, stay current and up to date with program guidelines. The more knowledgeable you become about what MLB Wholesale has to offer, the more confidence you're going to have when you go out there to the partners and have conversations with them about what you can offer to them and what opportunities you have to get those loans closed. That's exactly what making lives better looks like. So I encourage you to join us regularly and expand your toolbox when it comes to the types of programs you're able to offer. One final thought here. Temporary buy downs are much more than just a financing option. They're a conversation starter, they're a negotiation tool, they're a way to just help out those borrowers and overcome affordability challenges. And most importantly, they're just another opportunity to help families purchase a home that they probably thought was completely out of reach. We here at MLB are committed to be more than just a lender. We want to be a partner. We want to help you find solutions. We want you to close loans faster. We want you to build stronger realtor relationships, grow your business, better serve your borrowers. So if you have any questions after our presentation has concluded, our client services team is here to help. So whether you have questions about general guidance on eligibility, scenarios, structuring a transaction, don't hesitate to reach out to us at any time. You can reach out to the phone number that's listed here. You can either call or text us during our business hours. We're more than happy to help out with that. You can also reach out to your assigned account executive as well with any of those types of questions. So once again, thank you so much for spending some time with us. Only really together can we help more families achieve the dream of homeownership. And because here at MLB, we're not just closing loans, we're actually making lives better.